A charitable remainder trust is a split interest irrevocable trust. By being irrevocable, the transfer is permanent and you're not allowed to undo the transaction. It's a very effective tool for highly appreciated assets. It avoids immediate capital gains tax on the sale and transfer of the property. It also takes the asset out of the estate tax equation. It can lead to a stream of income in an annuitized fashion for an individual for their lifetime or individuals, or it can be for a period of time so long as that period of time does not exceed 20 years. It leads to an income stream that has annual distributions. The trust itself does not get taxed on income because it's exempt, and the payments to the beneficiary, the split interest beneficiary, does get taxed at their tax rate. The payments can be fixed, some like an annuity, or it can be a percentage of the trust. The percentage of the trust involves more risk, so the deduction is more favorable. It converts non-income producing assets into an income stream using the pre-tax amount rather than the post-tax amount. You can also reserve the right to change the charities so that you can name a charity at a later point. So let's walk through an example. Let's say that Sally is a real estate investor, or for that matter, she has stock that's worth a certain amount of money, but we'll say it's $1 million for the purposes of this example. Let's say that these assets are highly appreciated and her basis in the assets are $100,000. If she were to try to sell the property without first contributing it to the charitable remainder trust, she would have a gain of about $900,000, and the federal income tax on that would be $214,000, and she would have $785,000 left. From that, she can use the $785,000 to invest, and let's say she invests it and returns 7%. Her annual income on that 7% return would be $55,000. Now let's compare that to if she were to contribute the property to a charitable remainder unitrust and reserve an annual income stream of 7% annually. Unitrust just means that we're getting a percentage of the amount rather than a fixed amount. The property is sold by the charitable remainder trust for $2 million. There are no taxes paid because the charitable remainder trust received the transfer from Sally. The entire balance of the $2 million is invested by the charitable remainder trust to meet the obligations for the annual payment to Sally. Sally would get a tax deduction for a charitable contribution of $250,000, which can be set off against 50% of her adjusted gross income. She can carry that forward for up to 5 years. She would receive annually $70,000. Let's say that the interest that she's receiving on the unitrust version is 7% for the average. The $70,000 annually would be for life. You can actually have a fixed amount too, where it's a $70,000 payment per year guaranteed. The funds can also be used to fund a life insurance plan to replace the wealth for Sally's heirs should she choose to. Sally would avoid estate taxes of $400,000 upon her death, and she would still be able to give it to a charity of her choice. She can change the choices. So comparing the differences between a charitable remainder trust and a non-charitable remainder trust setting, the increase in income is $15,000 annually. There is an immediate tax deduction that saves her approximately $125,000 in current income taxes, and the asset is removed from her estate, thereby avoiding the estate taxes. The one problem is it removes access to the asset as well, so she needs to make sure that she has outside liquidity unless you can live on this annual income payment of $70,000 a year. A charitable lead trust works very similar to a charitable remainder trust, except the roles are reversed. The charity receives the interest payment, or the 7% payment, and the remainder goes back to Sally. She still gets the tax deduction, but it does not remove the asset from her estate or the associated estate taxes from them. Charitable remainder trusts work really well when we're dealing with highly appreciated assets, taxable estates, high tax rates for income taxes, and high interest rate periods. If you'd like to learn more, please contact Virtus Law at 612-888-1000, where we show you how a good defense scores points.